How's it going, everyone? Let's go ahead and talk about why dividends don't work. And then in the second half of the video, I'll give a counter response to each claim. Reason number one, dividends are not free money. The company has to stunt their growth in order to give you dividends. They are sacrificing cash to give it to greedy, ugly men like you. Taking a look at Apple as an example over the years, just this past year, they paid out $15 billion in dividends. And the year prior, $14.8 billion in dividends. Oh, disgusting. Reason number two, the dividend is already factored into the stock price and total return potential. Because of that dividend, you will miss out on a greater total return. And let me tell you, the total return is all that matters when it comes to investing. And let me explain this one because I lost you already. Stay with me, Frank. If you buy one share of the cheeseburger company at $100 and it increases by 10% to $110 a share, your unrealized rate of return is 10%, $10. And the best part about this business is that the cheeseburger company does not pay a dividend because it's still in the growth phase of their life. Now, let's suppose you also buy one share of the deli pickle company, which is also trading for about $100 a share. And the deli pickle company pays you a $1 dividend. But instead of reinvesting the dividend, you keep it as passive income. As a consequence, the share price becomes $99 from $100 because of that $1 dividend. And let's assume the deli pickle company also grows by 10%. But because they paid you a dividend, their share price becomes $108.90. When you add in that $1 dividend that you got, then the total return becomes $109.90, which yields you 9.9% as a ROI. Your initial investment capital is the same in both examples, yet your total return on deli pickle company is lower than your investment with the cheeseburger company who does not pay a dividend. Speaking of pickles and cheeseburgers, I'll tell you what, if In-N-Out or Whataburger ever decide to sponsor this channel, I would be stoked. And on that note, have you ever heard of Freddy's Steak Burgers? It's a burger chain that's famous in the Midwest and the East Coast. It kind of tastes like Five Guys if I'm going to be honest. And the atmosphere that they provide is kind of like a diner from the 1950s. And here's a funny story that's actually true. I had the opportunity to be sponsored by Freddy's about a decade ago. Unfortunately, I could not take them up on their offer because I just had too much going on at the time. Looking back, I wish I had the wisdom to partner up with a burger chain. But it's all good. Reason number three, dividends are treated as income, whether they are qualified or not, which means you have to deal with taxes. What's the point of those distributions if it creates a taxable event? And because of those stinky dividends, you might even have a bigger tax burden. Reason number four, dividend-oriented stocks and index funds underperform growth stocks all day, every day. My shares of Tesla have the potential to go up by 40% in a single year, and sometimes up by 5% on a single day. You dividend investors are lucky to see a 5% dividend yield on a 365-day basis. What a waste of time. What are you doing? And here's the next reason. Dividends only serve a psychological benefit. It helps your fragile and weak ego to see cash flow pouring in to compensate for how short and ugly you are. You justify dividend investing because it feels good to have cash show up in your account on a regular and predictable basis. Unlike your wife's boyfriend. He comes and interrupts family dinner time whenever he feels like it, and because of that chaos, you like the fact that dividends happen on a scheduled basis. And here's the last reason as to why dividend investing is trash and a waste of everybody's time. It's the fact that dividends are not guaranteed. The board of directors and executive leadership must approve each dividend payment. They can choose to decrease or stop a dividend payment at any one of those top brass meetings. If CFO Jimmy decided to wake up cranky that day and throws a fit about the dividend, he could peer pressure everyone in that room to vote against the next dividend. Oh, you thought I was just joking. There's a dozen recent examples of companies cutting or freezing their dividends, such as Intel, Disney, AT&T, Ford, Boeing, Estee Lauder, and the list goes on and on. And to make matters worse, sometimes dividend-paying companies will take out loans and go into debt in order to sustain their dividend. All because you want to be a princess and get a dividend, the company has to damage themselves financially. I hope you're real happy, pal. Dividends are so bad. Now that we have laid out all the reasons as to why dividends don't work, now it's our turn to refute the haters with supporting evidence and some common sense. But first, let's go ahead and take a deep breath. Ooh. Dividends are not free money. This is such a silly argument. It's like telling me that the UK has the best food in the world. Dividends come from cash. It's a percentage of net income, aka the bottom line, being paid out to the shareholders as a result of a profitable business. Dividends are a sign that the company is producing money in excess of what it needs to survive and grow. The key word being excess. I believe every dividend investor realizes that dividends are not free money. Think about it though. The dividends are given out to the shareholders because the company earns more cash than they need to support and sustain their projected growth. And it's tangible proof that the company you are invested into is running a real operation with profitable cash given back to you as a dividend. I say real operation because there are companies that are blowing smoke and mirrors to investors to drive hype into their business. You might think I'm exaggerating, but I'm really not when you think about Lordstown Motors and Theranos. It happens. And I will close my case for the first point with this. The reason why we invest into stocks is to get a return on investment, right? So for me, it's a given that a mature company should pay a dividend. A dividend is one way to get a return on your capital. We as investors are paying cash to the company by buying into their stock, and they give us cash back as dividends while they grow their company and stock price. I mean, let me ask you a question. What is the primary objective of a publicly traded company? The mission of a publicly traded company is to be profitable through their products or services, and by doing so, giving a healthy and sweet return on investment for the shareholders. What you see on your screen is Johnson & Johnson's credo, which is like their company mission statement. They have a whole paragraph dedicated to bringing value to the shareholders, and J&J is not alone. Most Fortune 100 companies operate with the shareholders in mind and prioritized. Next, let's talk about the total return argument. The total return of a stock investment being minimized because of a dividend is simply not true. If a company reports better than expected earnings or has a catalyst move in their favor, they'll see double-digit returns in a single trading week, which means their dividend will just be the cherry on top of those double-digit returns. We've seen this time and time again in the stock market. When we think about dividend companies like Texas Roadhouse, Microsoft, Broadcom, Costco, United Health, Nvidia, the list goes on. And elaborating on the example earlier of the deli pickle company producing a lower total return than the cheeseburger company because of that dividend, and as such, we concluded that the deli pickle company is trash. Kind of like your manager, you know, the one that always calls you out in front of everyone during the Zoom call meetings. Nobody likes her anyways. But keeping the dividend-paying deli pickle company example in mind, on the flip side, hear me out. Let's say the macroeconomic conditions force all stocks to go on a dip. So instead of most stocks growing at a rate of, 8 to 10%, they go down by negative 15%. With a growth stock, your total return is going to be negative 15%. But with a dividend-paying stock, even if they go down in share price, they'll still be paying you a dividend as you weather through the storm. And besides, when we think about the total return, the dividend-paying stock has the potential for gains throughout the year and between the dividend payments. Just because they paid a dividend, it does not mean that they cannot grow at a desirable rate. Investors can pile into a dividend-paying company as if it's a growth company at any time. If you need proof, just look at the top companies in the S&P 500 index, what you see on your screen right now. And let's go ahead and talk about the whole tax issue. I'm going to keep this one short because not everyone who does dividend investing is an American. The qualified dividend tax rates are not so bad, and that makes up like 85% of all dividends out there. And sure, when it comes to ordinary dividends like REITs or BDCs, or if you haven't held a dividend stock for too long, then the tax rate is going to be at your income level. But for most dividends, it's most likely going to be qualified, especially if you are a long-term investor who buys and holds the position. And the thing is, if you hold the dividend stocks in a retirement account like an IRA or or 401k, you do not pay taxes on those dividends. But anyways, qualified dividends are taxed at the capital gains rate, which is the same bracket that growth investors are subject to when they sell a stock. And for a lot of people, that tax burden of qualified dividends is going to be taxed at a rate of 0%, or maybe even 15%. If you are an average American bringing in about $74,000 a year for your household, and you make about $500 a month in dividends, you probably won't pay federal taxes on those dividends. And I'm saying that on the basis of if you are married and you and your partner bring in less than $94,000 a year. But yeah, non-qualified, aka ordinary dividends, might have a bigger tax burden, but it's still not the worst thing in the world when it's going to be about 12% for the average American household. But getting past the whole issue of qualified dividends being taxed at a rate of 0% or maybe even like 12%, this Debbie Downer might still say, yeah, but dividends create a bigger tax burden than you normally have to deal with from your W-2 normal job. Alright, I might sound like Captain Obvious here, but that's because dividends are income, and that's kind of how it's supposed to work. Getting a raise at your work results in a larger tax burden as well. Let's paint a picture here, Bob Ross style. Let's say you do really well at your job and crush all of your expectations and KPIs, and you're given the opportunity to move up the ladder. Your manager in HR tells you this will bump up your compensation from $40,000 a year to $75,000 a year. Does that mean you would turn down getting a raise at work because it pushes you into the next tax bracket? Let's be real. You would happily kiss your manager's ass if it means you can get a raise that high. Or maybe it's like saying you would rather only work 20 hours a week and reduce your earning potential to stay in a lower tax bracket versus doing 40 hours a week and shooting for that overtime pay. It's just nonsense, because let me tell you, that overtime pay is where the real money is made, unless you're an idiot like me who worked on a salary for the past decade. So of course you would opt for 40 hours a week because you and your wife's boyfriend will benefit from more income, even if you have to pay more taxes on it. And if we are going to be honest, most of us watching this video probably make $200 to roughly $800 a month in dividends. And I think that's pretty good. However, sometimes I'll see a portfolio that hands out about $10,000 a month in dividends, and that's the person I want to be when I grow up. I don't even know if I'm allowed to say that when I'm almost 40 years old, but it's true. And say you make about $6,000 a year in dividends. If you had the opportunity to earn a $6,000 bonus at work, would you turn it down because you don't want to pay taxes on it? Be real. You would not turn it down. And I'm not saying that money can buy you happiness, but with that $6,000, you could actually afford the down payment for that hair transplant surgery you've been eyeballing, you bald-headed bowling ball. No, but really, do whatever you need to do to feel better. But just know that whether you have hair or not does not take away from your worth as a man. The only caveat I have here is if you own REITs in a normal individual taxable account, those really high yield dividends will be non-qualified and will be taxed at your regular income rate, which means at a rate of about 12%, 22% for most of you. But just think about it. If you can have a 10% dividend yield taxed at your normal income rate, that's still better than having a regular qualified dividend yield of 2% taxed at the capital gains rate. And this is not advice, but I like having REITs in my Roth IRA account because taxes are a non-issue. And if that's the case, then you get the high dividend yield without worrying about the whole tax issue. So the way I see it is the dividend that I receive is as if I am working a second job, except the best part is I don't do anything except the initial research up front to know it's worthy of being in the portfolio next to Hershey and Starbucks. Now, from the second job and income I earn, of course I would be taxed on it, but I'll still be generating additional income each month that I wouldn't have otherwise, and that in itself is worth it to me. If your main job is boring or easy, working a second job to make additional money is not unheard of. As a matter of fact, I bet some of your coworkers are working a second job and you don't even know. I mean, of course, it's frowned upon by HR, but quite a few people do it. I remember this guy that I used to work with. He was a marketing manager by day, and on the weekends, he was a personal fitness trainer. And another Another example of second jobs is how a lot of teachers in America have to work part-time as an Uber driver to make ends meet. But in their case, it's out of necessity rather than opportunity. And hate me if you want, but I think teachers deserve to be paid more in the US, especially since they're tasked with the responsibility of educating our next generation. Before I offend anybody, if you don't have the motivation to work a second job, then dividend investing is the lazy man's golden ticket for a second passive income. And once you get into dividend investing, it opens your eyes to a whole new world, just like Aladdin. And soon enough, it could even become a hobby like it is with me. I'm pretty passionate about dividends on and off the YouTube screen, so you can go ahead and call me a plain vanilla cake.
Well, hey, buddy, dividends are inferior to growth-oriented companies.
The reason why some people even say that dividends pale in comparison to growth is recency bias. I mean, if you look at what happened very recently, then we see the 2020 pandemic rebound and the 2021 bull run, which makes it seem as if dividend investing is going to make you lose money and make your nipples more hairy. But it has been shown in academic papers and financial research time and time again that the class of stocks that outperform in one decade will be the next decade's underperformers, meaning there's a time and a spotlight for growth stocks. Kind of like Carvana. They're basically the Amazon of car dealerships, except the best part is they removed the middleman. You don't have to deal with any sales reps. The price that you see online is the price that you get. Bless their heart. I truly hope their business thrives. But anyways, for the past 52 weeks, their stock has gone up by 1,000%. And then there's a QB1, Friday Night Lights attention for dividend stocks in another time period. Speaking of which, the Atlanta Falcons just signed Kirk Cousins to a 4-year, $180 million contract. And then they went ahead and drafted Michael Penix with their first-round pick in this year's NFL draft. I don't know. I think Michael Penix is a great QB, but did they really need a first-round quarterback when they have needs in so many other positions? Please make it make sense. I don't get it. But getting back on topic, dividend-paying companies fall into a class known as value stocks. And that's why a lot of dividend investors are also value investors. And when taking a look at the S&P 500, which is often referred to as the market, it's a huge list of the biggest and most popular companies in the US. And when we look at the S&P 500 data extrapolated by Hartford Funds, this data is by them, it shows us that dividends are clearly better on paper than growth stocks from 1973 to 2023. The annual rate of return for dividend growers and initiators was 10% year over year from 1973 to 2023. But when you look at the companies that do not pay a dividend in the exact same time period, their rate of return was 4% year over year. It's easy to dismiss the dividend strategy of slow and steady, but over the long run, dividends will always come out on top. Just like that one awkward neighbor of yours. I'm talking about the one that insists on mowing his lawn at 6 a.m. in the morning, pissing off the entire neighborhood. Why is it that every city has that guy that just lacks manners and consideration for his fellow neighbors? But anyways, what you see on your screen right now is the change in valuation of $100 in that same time period. With the dividend growers and initiators, that $100 would have transformed into $14,000. For the ones who do not pay a dividend, that $100 would turn into $843. Now, this data point is when we examine the S&P 500 index over the years. I just want to throw that out there because when we think about growth companies, they're not necessarily going to be in the S&P 500. But regardless, if anything, this data shows that if you are a mature company, then it would behoove of you to pay a dividend. Okay, so dividend stocks are better than growth stocks in the long run. But some folks will still argue,
I can just sell my growth stocks whenever I need cash and generate my own dividends from selling stocks.
But my friend, my smelly, ugly friend, that strategy requires the stock market to cooperate with your retirement plans. Can you imagine planning a retirement in 2008 or in 2020? Would you really sell your growth stocks at a loss for a minimal gain because that's the year you decided to retire? Worst case scenario, you might have to hold off on putting in your 2-week notice and keep working at the job longer than you wanted to because your growth stocks are deep in the red for that year. With dividends, your retirement date can be a fixed date. You don't have to worry, set in stone. That's why I think dividends are superior to growth. Those dividend compounders with cheese will generate cash in any environment. Because here's the thing, when it comes to growth stocks, you won't know what the share price will be when you are ready to sell and cash it out. With dividends, on the other hand, you will be generating income regardless if the stock market goes up or down. And if your retirement is contingent upon getting a 5% dividend yield, then you'll still get that 5% yield, even if the world looks and acts crazy. So this is where you clap your hands. Dividends are better than growth stocks. Now let's talk about this reason right here. Dividends only providing a psychological kick is hilarious to me. You are the class clown, a stand-up comedian. I disagree with that statement because dividends serve a very practical purpose. The dividends can replace your active income to fund your retirement, mortgage bills, insurance, and even weekly Costco runs. And not only that, some people use the dividends to literally fund their strange hobbies like doomsday prepping or to take their spouse out on a nice date. So tell me again how dividends are only psychological. But I will take a step back because, buy a share and get a share of the profits every 3 months. Yeah, it does feel nice, I'm not gonna lie. Those dividends pouring in reminds me that I am an investor and an owner of the company. And it's not just buzzwords. It's kind of cool to think about, really.
Yeah, but listen here, buddy. Dividends are not guaranteed.
Using that logic, growth is not guaranteed either. The growth company could burn all their cash trying to seek profitability and go bankrupt. That's why dividend investors choose to invest in high-quality dividend compounders because the likelihood is high that the dividend will be paid on a scheduled basis, but also that those dividend payouts will become bigger over time. So before you try to tell me that dividends are not guaranteed, it's a fact that dividend income is far more predictable and stable than capital appreciation in a stock price. McKinsey, one of the prestigious management consulting firms, found that from 1995 to 2021, in a typical year, fewer than 2% of the 1,225 large cap companies reduced their dividends. The number of companies that cut their dividends only increased when there was an economic crisis. For example, more than 5% of companies reduced their dividends during the 2009 Great Recession, and more than 15% reduced dividends during the COVID-19 pandemic. But I will go back to saying, if you invest in high-quality dividend compounders with cheese, the thought of the dividends getting cut is just not in the conversation. They'll be a part of those 95% or 85% of companies that will roll right along. When you invest in companies with negative free cash flow, a high payout ratio, a declining top line and bottom line, then of course the dividends gotta go. So when I think about those companies that reduced their dividends during the Great Recession, they were probably struggling on their balance sheet. And those are the ugly and disgusting companies we as value investors tend to avoid. Speaking of avoiding, don't forget to put on your sunscreen when you go out this summer. One of my biggest regrets in life is that I did not use sunblock until I was in my mid-20s. And although the sun is amazing in many different ways, skin cancer is still a real threat, folks. So if nobody is going to remind you today, I just wanted to let you know. Here's the thing. When it comes to investing, it's all a matter of preference. High dividend paying companies have a different strategy and vision than the growth-oriented companies. When I think about startups and growth companies, they're probably concerned about, growing the business. That comes in the form of using all of their free cash into expanding business operations, ramping up R&D, overhiring their sales teams to pitch potential clients 24/7, and on scaling their services. On the other hand, when we think about dividend companies, they're more mature, seasoned, and they will have a full headcount in their HR department because they have more money than they know what to do with. And to be honest, as someone who worked closely with HR, I can tell you, half of them can be fired or let go and the company would operate just fine. But anyways, when we think about these dividend companies, they cannot maximize their growth by using all of their profits in cash. Thus, these mature companies create value for the business by giving those profits back to the shareholders. By doing so, it makes them attractive as a business to invest in, despite not growing as fast as their growth counterparts. And based on the data that we review today, giving back to the shareholders will yield a higher ROI for the business. So if you can agree with me that investing is a very personal decision, like what kind of spouse you end up marrying, or if you trim your pubes or not, then you probably see eye to eye with me. We cannot judge you for your preferences and style. But when I'm old and retired, I would love to see a number like $65,000 a year in dividends pouring in. And if that dividend payout grows at a rate of 4 to maybe 6% a year, I would be a happy camper. And in order to achieve that, it requires a portfolio dedicated to acquiring a list of dividend compounders with cheese over the years. This cannot happen overnight, and that's why I enjoy this journey. It's a slow, steady pursuit of passive income that will compound upon itself from reinvesting those dividends to buy more shares. And if you're into gardening or farming, you understand this grind of planting, tending, maintaining, and caring and harvesting fruit, produce, or flowers. Because that's the goal, to live off dividends, never touch the principal, and pass the portfolio down to friends or family, or to your secret gay lover. Ain't nobody judging you. Remember, we already agreed upon that. So I'll close this video out by saying, it is far easier to predict a company's future dividend payouts than it is to forecast a company's future share price. So for me, despite the hate for dividends, I'm going to continue to choose dividend growth investing. And I'll tell you what, when the markets turn south like they have recently and things look bad and scary, to have a dividend payment pour in despite all of that will help me to sleep at night. But do you? If you are into gambling, high risk, high reward, speculative nonsense where financial fundamentals don't mean a thing, you are probably annoyed by this video. And I welcome your dislike. But one thing's for sure, with maturity and wisdom, we all end up as dividend lovers. With that said, dividend compounders with cheese, signing out. Stay safe, everyone, and I'll talk to you next time.